Okay. All right. Any questions? Any comments?
Ramin, I have two questions.
Please.
Thank you for showing the charts. It's very informative. Just two things bother me. Firstly, by looking at the components of the Russell 2000, I think the biggest ones, the financials, the second, the healthcare, and the third is industry. All those sectors, I think, are not weak, right? Why Russell 2000 has such a weak pattern?
That's a good, well, again, good question. There's concerns. You're looking at basically now we have to differentiate, the components, or we are looking at the small cap versus a large cap. So when you think about financials, mainly looking at the mega caps and big banks, and then although I like actually the regional banks, so but it's still there's industrial, there's some tech, there's some energy, but they're the small companies that they are not really keeping up with what is the big brothers like ExxonMobil, the Marathon. We look at Occidental. They've been doing well. But as far as, when you have 2,000 stocks, and when you look at that, it's the perception of what the inflation is going to do. And also, again, if you look at the value side of things from the Russell, they have actually been outperforming the growth side of it. So the 2,000 stocks, I think if I look back to their components, you don't have really like energies, perhaps maybe 7 or 8% of it, if I'm not mistaken. And then even the healthcare. So it is more of a perception of the smaller caps. They do not have the pricing power, for instance, and that's why they're getting affected. Does that make more sense? Just because of, I think this is just more of a size issue rather than the sector issue.
Oh, I see. Yeah. I was thinking the interest rates rise would benefit all these financial small companies, especially, right?
Yes. So, I mean, well, the regional banks can get, but some of the small banks, again, the competition and other things, but only that's still, I think, maybe 15 to 20% of the whole index. So when you have 2,000 stocks, it's the perception of the smaller companies. And also, remember, there's a lot of institutions buy these indexes, the basket. So for instance, the IWM is the basket, and that's also can have the redemption. So, but what is also telling us, once we get some consolidation, then maybe the value side of the small cap, which was actually a winner, believe it or not, small caps didn't do well last year, but the small cap value did well. That's why I'm saying you have to segmentate this. So don't look at just Russell 2000 as a whole. So the Russell 2000 value beat the Russell 2000 growth by wide margin. So, so the financials are part of the value. You're absolutely right, but that's only, as I mentioned, 15 or 20% of the index. So,
sure, yeah. Thank you for
the question, though. Excellent.
Thank you. My second question is, by looking at today's greedy and fair index, it's still in the greedy zone. It's 60. How could that be? I thought everybody was talking about the market went into correction. It's still like greedy 60. How could that be?
It's human emotions are amazing in the sense that we still have this buy the dip mentality. And I think that's still thinking that, once we get to that, because in the past it has worked. I mean, this week we will look at like the weekly and then the daily. You see every time we've gone to daily support, we've had like an 100-day support, for instance, for like S&P, even NASDAQ. Oh, the buyers come in. So the problem runs into is that mentality worked for last year and a half or so, but would it work? So right now there's this positiveness. Oh, it still worked. This is bargaining. But if we have another breakdown, I think today after 5:15 p.m., I think maybe a good time to check, because I think it's a couple of indices we broke that support. So I probably will discuss this maybe Saturday. We can review that to see what is happening. Now, also you have to remember what are the components of the fear and greed. So there's a 7 components, and basically there's a put call ratio. And as one of the interesting things I've also seen is that skew. Skew has been actually one of the lowest we have seen. We've discussed this in summer, if you recall, and we noticed that skew was one of the highest. So when the skew is really high, what that tells us that the hedge fund managers are expecting something is going to happen. So what they do, they hedge themselves by mostly buying puts, which that increases the premium on the put side. The interesting factor right now, and that was also, I didn't discuss it last week, which there's so much I want to talk about. I forgot to talk about this, so I'm glad you mentioned it. The skewness is actually one of the lowest. We're in the 130s right now. What that means is we are not, or at least the hedge fund managers are not protected. And because of that, if things really radically go down, then they're not prepared. So things could accelerate. So, but the components of, they look at I can't completely remember the 7, but again, the put call ratio, they look at the new highs and new lows. They look at the treasuries. So there's a 7 components. So that's pretty dynamic. So I would look at it today at after 5 o'clock, Sean, and then we can discuss that. But that's a good observation as well. And so while like the American Association of Individual Investors, which came out today, so I mean tonight will be coming out, is more of a survey, and every week I'm getting it right now. So I'm getting twice in one day, actually. Please do the survey. It's more of a human emotions. The other one is more of an underlining of the reaction of, again, the sentiment, not the complete emotions of the surveys. So,
Yeah,
but we'll
thank you
revisit
very
that.
much.
I will look at it tonight, actually. So.
Yeah, I just read news. It says after today's close, the Nasdaq went into correction, 10% down from the top.
Okay, yeah. So the 10%, I mean, we really haven't had much, the 10, yeah, the 10 is a correction now. So.
I also have a quick question as well.
Yes.
Regarding that same thing you guys are talking about as far as human emotion and the correction, when I was looking at the VIX, I've noticed that in the beginning of last year, December, the VIX was the highest. It was just really high compared to what it is now. And NASDAQ and S&P 500 have had the biggest drop that we've seen in quite a little while, but the VIX still isn't as high as it was, as we saw it historically in the past couple of months. First, I want to know your thoughts on that. And then second, how much is that based off human emotion too, or is that more of a fundamental thing?
Now, that's an excellent question. That's another thing I wanted to address last weekend. No, you're absolutely right. What has happened, again, we've had, if you recall, it was end of the year, we had the Santa Claus rally. There's that positive human, expectations, it's a new year. So the volatility actually collapsed. But underlining, and that's what I like to look at. So the VIX is at a 30-day, again, that option volatility. But that's what I like to look at, the futures market on the VIX. And I want to see what are we looking at right now. We're at the February. So what is happening in, for instance, April, and when going forward, March. And And you could see that expansion. So you knew by looking at the futures market, something is happening. And that's what I liked at VVIX. The volatility of VIX was telling us, listen, although the VIX came down, but the volatility of VIX still was up there. And I use that 110 area. So your observation is correct, but just because of we were coming from such a good Santa Claus rally, and but underlining the volatility was brewing. So this is going to be now, I think you're going to see that the VIX expansion. Now, old days, I mean, there was something, believe it or not, before like 2016, there was the VIX was usually, 15 was really high. It's a 12 to 10. That was a normal, and that was, but like after Trump's, President Trump's election, the market decided to put about 20% premium on VIX. So all of a sudden, because they thought there would be some unexpected things, so all of a sudden, after 15 and 16 became kind of a norm, and that's what, if you notice, we usually haven't gone down below like 14 and a half, 15. That has been our support. While if you go back a decade, it was like, oh, that's a high VIX. So right now, that's the expectation is that, again, I go back to exactly the question Sean mentioned. It was that the human emotions, but we're not expecting this. They were not expecting that the interest rate will behave and then the markets will behave this way. And of course, the hope was that the Fed will rescue. There's still time. I mean, as I said, we have the Fed meeting next week, so we'll see what they have to say. But there's a lot of damage is done. The other thing is you have to remember the markets, they sell and then they ask questions later. So there is some redemption right now because of that. I'm looking at the big caps especially, but underlining there's some opportunities. And I think that's what, again, I want to look at the monthly, see if you can find when the right opportunity comes. And that's my emphasis is perhaps looking not quite yet there yet, but like maybe some of these international investments can come into picture. Of course, there's politics involved. There's got a lot of elections coming this year around the world. So they will play an effect, but are there other opportunities than Teslas and Amazons and Facebooks of the world? So can we move with different segments of the investments?
Yeah, okay, I understand that. And then, yeah, I've been mainly I've been avoiding just the stock market in general, just been focusing on futures mainly, just gold, oil especially, because I think today was the highest it's ever been in history. And I'm curious to see if it either goes to $100 or just play around that zone for a bit, the $86 zone. So that's kind of fascinating to me as well. And then gold has been an interesting thing to play as well, because I think today it's spiked up pretty significantly. I was in it for, I'd say, like a tenth of that move, and then emotion got to me. I got out of it and it kept going, and I was like, wow.
Yeah. I mean, gold is actually pretty orderly, so which is good. It does like to move in 25s, something about that. So when it comes down, and it likes to continue like to 50s and 100s. So something about 25s. Silver is the one, if you're doing futures, silver, I would definitely avoid. It's a home wrecker. So I would not do any silver $5,000 contract, but silver is good for if you like to play ETFs and for options. They are pretty liquid. Crude oil, actually, we hit 147 on crude oil, so there's still room to go, but it's still the forces. It's still with the Omicron, with China's story and other things. I'm not sure right now. I think it's Saudi Arabia and Russia dictating the game at this moment, and of course, again, a little bit of, we talked about not the terrorist attack or whatever with the Yemenis. I mean, all the market needs is a little bit of that. And then, Russia stopping the supplies to, for instance, to going toward to Europe and all that. And on top of that, you look at Kazakhstan's unrest, which is natural resources. So there's a lot of these geopolitical effect working around it. And then the nuclear talks with Iran. And so there's a lot in force, but I believe that can be resolved with a little, movement, let's say, from United States, if the more rigs open and more companies are getting more fixed at shale oil, and that could resolve that. But right now, as I mentioned, this Russia and Saudi Arabia have upper hand. So basically the oil. So we are in that inflection point. I mean, we shall see. We might have a big spike up and then have a correction. I mean, that's how Russia is making a lot of money. I mean, that's helping them tremendously. So why not?
I understand. Okay, thank you.
You're welcome. Any other questions or comments?
Here, I mean, when it comes to commodities, like what is, you mentioned DBA. Are there any other like ETFs that you would recommend just on, on a general basis? Yes,
I mean, there's one of the problems with these commodities are, well, many of them are future related. So of course, again, we talked about the rolling and
right, yeah,
tangos and all that. So the other problem is the liquidity. So for instance, some of the main ones, now there's a DBC, for instance. DBC is more on the precious metals. And I do, if you like, maybe if you have time to look at some, I have a commodities video, and I put like all the ETFs in there.
Oh yes, yeah.
Look at that. But one of the problems is like Jim Rogers, for instance. Jim Rogers is a big, George Soros's partner on Quantum Fund. He went retired. He's in Singapore. He loves commodities. So there is, the Rogers commodities. So there's quite a few that they follow his index. Then you have the Bloomberg, for instance. Bloomberg has their own indexes. So there are quite a few Bloomberg. There's a food and beverages, and there's agriculture. So you have like wheat, which is WEAT. You have corn, which is CORN. If you want to play lumber, you can do cut or wood. If you want to play coffee, you can play Joe or cafe. If you want to play sugar, you have SGG or cane. If you want to play cotton is NIB, and so on. I mean, you do have, there's quite a few actually. The DBA is the largest, actually most liquid, so that's what we use. But there's like, again, for coppers like JJC or COPX. So there's a lot of them that they can be good. The problem, as I mentioned, let's say the problem like UNG, which is for natural gas, is that futures element of it. The other problem you run into is obviously because of that, then at the end of the year, you get the K1 form. So some people don't like it because that's extra work they have to do for, the accountant. And then it's just very simple things, but the accountant has to go through it and charges more money to do that. So, but there are quite few, especially now that we've gotten more interest in commodities, you will find a lot more. But the DBA is more of a diversified non-metal, and then DBC is more precious metal oriented.
Got it. Thanks, Ramin.
You're welcome. Any other comments or questions? And then if you don't mind, and if you have anything as far as like the following Saturday's meeting, that would be great. We can discuss more. As I said, I would love to have you over, and we can put our heads together to look at the future. Other than that, if there's no other questions, then I look forward to seeing everyone on Saturday. I hope this was helpful, by the way. Again, it was something I thought, again, because of the movements, it would be timely if we did some charts and then we can talk about fundamentals and mining and other things. So, okay. All right. If no more questions, again, I thank you so much for being part of this family. I wish you an exciting and wonderful next 2 days. And I hope to see you on Saturday. Thank you, everyone.
Thanks,
Thank you,
Ramin.
Ramin.
Thank you,
Bye.
Ramin.
You're welcome.
Okay, see you, I mean.
Thank you. Bye-bye now. Sure, thank you.